The biggest single-day sell-off for SK Hynix ever. 30 minutes until the start of cash equity trading. I'm Dani Burger.
And I'm Dani Quinn. Bloomberg Open Interest starts right now.
Coming up on today's show, more tech turbulence. SK Hynix leads a chip sell-off after its Wall Street debut.
And investors face a packed week of catalysts with big bank earnings and key inflation data in focus.
Plus, fresh strikes drive up oil prices as President Trump vows to take over the Strait of Hormuz.
Let's get to some individual stocks to watch. SK Hynix has to be the one we're all watching today after Friday's historic listing where the ADRs jumped 13%. Well, the stock fell the most on record in South Korea today amid growing investor concerns that the rally has become overstretched, trading at a 27% discount to those ADRs now, Dani.
You mean to tell me a record listing of an ADR that literally everybody in the world knew about wasn't a bullish event for this market? Who would have thought? The AI trade, though, it's completely under pressure today. Had a second quarter earnings results starting this week. We did get some sales numbers from TSMC. They were good, a 36% quarterly jump in sales. Demand is strong, but traders say there will be no mercy for earnings misses this quarter. Nvidia and Micron, those shares down at least 5% for Micron. Maybe it's the story of Samsung. Expectations are high, so even if you beat, you're going to sell off, Ani.
Well, we've seen it before, Dani. We'll see it again. Let's dig into the sell-off now with Bloomberg Tech's Ed Ludlow. So, Ed, what happened?
Yeah, the why on the Korean session is very difficult to answer. There are some local reports about maybe SK in the near term presenting numbers that aren't as rosy as the market had assumed. Certainly in the Korean session, people are asking the questions that maybe we did ask on Friday during the start of trade of those ADRs, but essentially whether this was the correction we were due in some names that had had terrific run-ups, right? You know, SK is still up 180% year-to-date in Korea. It is down 30% from its prior peak, but it's a stock that on a 12-month basis was up almost 1,400%. You know, there's been a lot of focus on how core they are to the memory story, but lots of people in the markets, Vonnie, and I think we did go over this at the end of last week, right? Saying that a pullback was not just inevitable at this stage, but it's something that's quite healthy.
And maybe it has larger consequences, Ed, given your interview with SK Hynix and the desire maybe to bring more shares to the United States. I just wonder how much of this AI trade, not necessarily the trade, but the spend by these hyperscalers really hinges on their ability to see stocks continue to rally that allow them this cheaper cost of capital.
Yeah, it's why the conversation's already moving to this earnings season, right? Because capital expenditures are one data point. What you said about the future, you know, it was the same with SpaceX, to be fair. But when we were in at the Nasdaq Friday, the question is, when does SK think about, or how regularly does SK come back to the market, sell ADRs? And you know, ironically, the point that Chairman Che made in that interview was, well, not until we see price stability in the ADRs and we see some return. So like clearly in the first instance, you know, the fact that the ADRs are down almost 10% and following the Korean session is logical because of how they're structured. But yeah, they might be waiting a little while. Yeah,
we certainly are not there yet. Ed, thank you so much. Again, a really fantastic interview on Friday. Bloomberg Tech's Ed Ludlow. Turn into Bloomberg Tech in about 2 hours' time. Let's turn to Wall Street earnings, though. 5 of the 6 largest U.S. banks are set to report tomorrow, offering investors an important read on lending in the broader economy. Let's get to Bloomberg Intelligence Senior Bank Analyst Herman Chan. Herman, why they got to do this to us? That's way too much. 5 on one day.
It is a lot, right? And then 2 of the earnings calls are at the same time. So we've got our hands full tomorrow for sure.
We definitely do. Do you expect it, though, to be a broadly constructive day, let's say?
I would say so. There's really high expectations. We just talked about tech expectations going forward. The bank stocks are up about over 17% in the second quarter, and analysts are estimating earnings up 20% year over year. That's really led by trading, investment banking, and then lending activity as well. So really high expectations. We'll see if they meet that bar.
if we see a disappointment, where is it going to come from, Herman?
Yeah. If there is going to be a disappointment, probably on the net interest margin side, given the fact that we have rates steady on the short-term side for the foreseeable future until potential rate hikes later in the back half of the year. And then there's a lot of loan demand. So in order to fund the loan demand, you might have higher funding costs, particularly on the deposit side. So that's something that we're looking for throughout the banks that are reporting next week.
Does credit quality largely look healthy? Because we have seen some consumer reports, from thinking of Pepsi last week, that did start to show some consumer stress creeping in. Do you think any of that will show up among these banks?
I think that's going to be a key question on the earnings call from the analysts, where analysts will probe if you're seeing a pullback in spending on the consumer side, given the fact that we've seen higher energy costs. And what does that mean for consumers that are paying back their credit cards, paying back their mortgages? How is credit quality holding up? And are there any early indicators in terms of delinquencies and the like that really point to a deterioration in the economy?
What will we hear from the regionals that'll differ from the big bulge bracket banks? That's
right. So the regionals, a lot of the same factors that the big banks are seeing are also happening on the regionals. There's a really strong resurgence in lending, particularly in commercial lending. Your bread and butter small businesses, small and then medium-sized corporations are really driving growth, and they're more comfortable with the backdrop where last year there was concerns about tariffs, then the geopolitical concerns. A lot of the sentiment seems to indicate that these borrowers are okay with where we are today and are taking a bit more risk in building capex and building plants, equipment, et cetera. So that's helpful for the regional bank space.
All right, Herman Chan, thank you so much. No doubt we'll be speaking with you again several times this week. That's Herman Chan of Bloomberg Intelligence. Brent moving higher after the US and Iran exchanged fresh strikes overnight. President Trump telling Fox News this morning that the US will take over the Strait of Hormuz. Joining us now is Bloomberg Washington correspondent Tyler Kendall. How exactly is the US planning on doing this, Tyler?
Well, Vani, we didn't really get much details from President Trump, though it does seem to indicate longer-term U.S. involvement when it comes to the strait, since at this point the standoff over the waterway only really appears to be deepening as we get conflicting information from both sides on the exact status when it comes to what's happening with traffic in the Strait of Hormuz. Iranian state media earlier today reiterated a threat from the IRGC, which said that they are going to close the strait unless the U.S., quote, ends interference, as we know that the country has been dismayed by the fact that more vessels are using that U.S. coordinated route that hugs the coast of Oman instead of taking that path that would get them closer to the Iranian coast. There are a lot of different factors to watch here because it is very clear that this White House's patience has worn thin when it comes to the status of the strait, as over the weekend, CENTCOM confirmed that the U.S. military conducted 3 waves of strikes ultimately aimed at degrading Iran's capabilities to interfere and target commercial shipping. But Dani and Bonnie, we're really seeing those ramifications already take hold of this latest wave of escalation in just the past few days, because basically all of that traffic, observable traffic, has come to a halt. According to satellite imagery, though, our analysts at Bloomberg Intelligence analyzed the data, and they say for the last 3 days, the so-called dark crossings, when ships go through with their transponders off, those are now exceeding those observable crossings as commercial shippers show that they are weary of what has been this wave of attacks.
Peter Scheer of Academy this morning basically saying that it appears that Washington is approaching this with a priority of reestablishing deterrence, that is, showing their military might to deter Iran from trying to control the Strait of Hormuz or preventing ships from going through. Tyler, does it essentially seem that any hopes for continued talks are dead at this point?
Well, according to the White House, they're not. The president still says that he will let his negotiators move forward, but he doesn't necessarily think that it's going to actually yield some sort of tangible result. For months, the White House has said that it has been prioritizing a diplomatic solution to the conflict, but it has become very clear that Iran isn't willing to give up its leverage when it comes to the Strait of Hormuz, even without the carrot of that sanction waiver that we saw the U.S. just remove last week amid this escalation. It appears evident that Iran is saying that its control over the strait would take precedent over that potential financial benefit that the country would get from selling its crude to market. Definitely something to watch here, but the U.S. military is making it very clear that more could be to come. We heard a threat from CENTCOM saying that if Iran does not issue this statement saying that the Strait of Hormuz is open, there could be additional attacks after more than 140 targets were hit over the weekend, according to the U.S. military. But Dani and Vani, we saw Iran take the opposite tact. In fact, it hit one commercial LNG tanker over the weekend and instead said that the strait is going to be closed unless the U.S. cedes to its demands.
And price of oil higher by 3.5%. Tyler, thank you so much. Bloomberg's Tyler Kendall in Washington, D.C. That's the latest on oil markets. A check on broader markets being dragged down by semiconductors after SK Hynix in the Korean session logging its biggest one-day drop on record. At one trading day after cross-listing in these United States, the Nasdaq leads losses down by more than 1% as 10-year yields creep ever higher. We're higher by about 1 basis point, 4.57, with 30-year yields back above 5%. Vani.
Well, let's get a look at some other movers on our radar, Dani. Bloom Energy down as much as 13%, although it's well off its lows now. This after Hunter Brook Capital disclosed it is shorting the stock. Bloom Energy told Bloomberg it's reviewing the report and will, quote, correct the record.
Spotify, meanwhile, upgraded at Jefferies ahead of second quarter earnings. Analysts say that they will likely beat estimates as its AI tools start to show improvement.
Shopify up almost 3% there. And a check on the travel sector as oil prices climb, as you can see. Not looking too good for the airlines, although we're really only down about 1% apiece. Same for the cruise liners.
Coming up on the show, it's a huge week for economic data and Fed speak. Kevin Warsh heads to Capitol Hill. We'll talk through the details with Michael McKee next. This is Open Interest.
Now to high interest to look at what's making headlines around the world. South Carolina is facing a scramble to replace Senator Lindsey Graham after his sudden death over the weekend. Governor Henry McMaster will appoint an interim senator, while a special Republican primary could shake up the race ahead of November. The vacancy temporarily narrows the GOP's Senate majority as both parties watch that seat closely. Meta is dramatically expanding its Louisiana AI data center, boosting the project's costs to over $250 billion. The campus will deliver at least 5 gigawatts of computing power and support 1,000 jobs. The move also underscores Mark Zuckerberg's massive AI infrastructure push as Meta races towards superintelligence. And Fed Chair Kevin Warsh faces Congress this week as investors press for clarity on how he'll respond to inflation, jobs and growth. Warsh has rejected signaling future rate moves, but critics say he's also failing to explain the Fed's reaction function, leaving markets looking to other officials for guidance. Dani.
It's going to be a busy week because alongside Warsh's Capitol Hill testimony, we're also going to maybe get a clear picture on this economy. We'll have CPI and retail sales and PPI this week, along a lot of bank earnings. Let's bring in Bloomberg International Economics and Policy correspondent Michael McKee. Mike, let's just start with the data. CPI, PPI, what are we expecting?
Well, you remember the old days when we just talk about inflation, because it could go either way,
sure.
Not inflation or deflation. We might get that this week because CPI is expected on a month-over-month basis to drop for the first time in 6 years, the first month-over-month drop in 6 years. And that's because energy prices went down over the month with the so-called ceasefire that is no longer in place. PPI on Wednesday, and that's going to give us some sort of clue as to pipeline inflation pressures also expected to go down on a month-over-month basis. But the real question is what's happening with services. That's what the Fed's going to be taking a look at. We'll get some kind of picture with that with the beige book on Wednesday as well. And Thursday, did you guys go shopping? I noticed you and Dani have, you and Tyler have the same jacket. Maybe you contributed to retail sales. That's something to watch as well. And then, of course, Friday we wind up the week of prices with import prices. But it is CPI that's going to matter, CPI and interest rates, and what we have seen with the rise in the consumer price index. You can see it crossed over wages there. The yellow line is the December market for Fed rate increase, and right now we're at a little more than 1.5. So that's gone up a little bit in the past few days, and depending on what we get the next 2 days.
Just to set the record straight, Tyler and I did not shop at the same place for tech. It wasn't coincidence, but I'm expecting you to add to retail sales and match us next time.
Yes, I will get a green stick.
The semi-annual testimony doesn't usually tend to move markets, but this one has the potential to, Michael. What kind of question might we really want to hear from Kevin Warsh on?
Well, you were just mentioning the idea that the market wants to know how they're at least thinking about how they're going to react to higher prices if they get that, because he doesn't want to give forward guidance. We've got 11 Fed speakers this week, including Kevin Warsh, and that doesn't count duplicates. They're all going to be offering their opinions on this various stuff. Today we start with Chris Waller. So while the focus is on Kevin Warsh, and he's not going to give guidance, we may get guidance from the others or some of the others. What you're probably going to get out of Kevin Warsh is maybe a little bit about how important it is to bring prices down. And also, I bet you're going to hear the words, there's a task force for that.
Oh, I'm sure you will. But that's an interesting point. That's what I wanted to ask you about. With Waller today, I wonder if we're just going to be looking to him and other FOMC members to really divine what the reaction function of this Federal Reserve is.
I suspect that Waller's going to be the counterpoint to Kevin Warsh going forward, since he has the sort of most the deepest economic chops, and since he's been right about several important turning points in the past, people will look to him for guidance on how the rest of the committee might be thinking, until and unless Kevin Warsh gives us more of his own views, which at this point he doesn't want to do. So Waller is someone to watch going forward. I'd say Jay Powell, but he doesn't want to talk, so we probably won't hear from him.
He is not going to talk. Also, the difference now between now and the FOMC is that there is actually a task force for that. There wasn't at the time. There was no personnel. Michael McKee, thank you so much. Coming up, Citi's Stuart Kaiser talks tech volatility and the high bar for earnings this quarter. Also, what he's watching from the Federal Reserve. This is Bloomberg Open Interest.
40 minutes ago until the start of your cash equity trade, we're being dragged down by chip stocks this morning, down more than 1% for the Nasdaq after SK Hynix booked its largest decline ever in South Korea. Brent crude, that's up 3%. As Iran says the Strait of Hormuz is closed, the U.S. says it's not, that they're going to take control of it, and the dollar unchanged this morning. Let's bring in Citi head of U.S. equity trading strategy, Stuart Kaiser. Stu, great to see you this morning. And look, already we had seen some previous bleed over from the Korean session. Like, chip makers have a bad day and the U.S. does poorly. I wonder if that relationship gets even more exacerbated now that we have this big listing in the form of SK Hynix ADRs in the U.S.
It's going to be interesting because what the ADR does, it actually provides you U.S. hours liquidity and access to these stocks in the way you have it in the past. And for that reason, you have a huge premium. I mean, the Hynix shares probably traded about a 25% premium in the U.S. relative to Korea. So, yeah, it does kind of create a little bit more reliance, but to some degree, it gives you sort of U.S. hours liquidity in a way that you haven't in the past. And hopefully more liquidity means more price discovery, and these things kind of calm down after a few days.
Yeah, I mean, the shares were down 15% in Korea. The ADRs are only down 8.5% in the pre-market, right? But it does speak to this idea of contagion, right? So Korea never used to affect the US market, not very often anyway. Suddenly it seems to be. Is that just because of the two chip makers? It's the global chip trade?
Yeah, it's the global chip trade. I would even broaden it out. It's the global AI bottlenecks trade. You know, it's just massive amount of CapEx spending coming from the hyperscalers at Mag 7, and people are following that spending down the supply chain, and they're ending up in a lot of these memory stocks in Korea. And, you know, you've also added leverage to a lot of these trades via levered ETFs and other approaches. So, yeah, I think it's that theme has become globally interconnected in a way that it hasn't been in the past. And to your point, half of the Korean index is two stocks. So, you know, that's the epicenter of that risk potentially.
Given all the leverage and given just the huge amount of ownership, household and otherwise, to these chip stocks, is what we've created is just chips becoming a high beta trade. Today, for example, there's no clear reason to sell off, maybe after the euphoria of getting this listing of SK Hynix, but we do have a little bit of risk off because of what's happening in the Middle East. And I wonder if chip makers become just that, just high beta now.
Yeah, I mean, they definitely are. It's a tricky one with this whole AI trade because it's not just the chip makers. You know, our quote unquote AI basket is the equivalent of 60% of S&P market cap. It's over 100 stocks. So I would argue the concentration right now is in the CapEx spending side of things. It's 6 companies in the U.S. that'll spend more than $1 trillion on CapEx next year. That is a very concentrated spend, but that spend then gets it's like trickle-down economics. It kind of spreads throughout the market. So right now, the chip makers and and the memory stocks are sort of the flavor of the day, but people are kind of hopscotching around. But again, I think if you're looking at where is the concentration, it's actually more in the spending than it is in the share price performance. I mean, you have the S&P up double digits year to date. The Mag 7 are about flat on a year to date basis. And what does that do? That is they are the spenders, and that spending is then translating through to earnings and price performance of other stocks.
Stuart, you had been very hot on the broadening trade, right? I guess, rotation trade. Are you still as convinced that it's going to continue on for the rest of this year?
The Mag 7 sort of AI theme?
No, the rotation out of some of that.
You know, it's interesting. Yes, you are getting some rotation out of Mag 7, but it's staying within the tech complex, right? So it's kind of like a mini rotation or a half rotation. If you look at what's not owned in the market, it's things like software, it's things like healthcare equipment, it's the non-AI part of the industrials trade. It's a little bit of financials. So, you know, what you have to ask yourself if you're an investor is, I'd like to rotate, but then I give you the list of, okay, this is what you have to buy. And it's like, you know, maybe not quite yet. So I think what we've seen, to my point earlier, is a broadening out of the AI trade, but the rotation has kind of been limited still, you know, broadly within that space. What would get you out of that trade? You know, there's a good way to get out of that and a bad way to get out of that, I think. You know, the good way is the market keeps rallying and it just drags those laggards higher. The bad way would be you get a broad-based de-risking and the favorite stocks get sold. We're obviously hoping for the first, you know, not the second outcome in that case.
Can I just ask, not to split hairs, but is it even fair to call what's happening in tech a rotation right now? Because it feels like this back and forth between whether the chip makers or Mag 7 are having a good day. It doesn't really seem to be a clear kind of consensus or winner emerging at this moment.
Yeah, look, I think the rotation trade within tech would almost necessarily have to be selling semis to buy software. And we've seen that for a day or two. We've not seen it sustainably. And I think what you're describing, frankly, is the AI trade has become much more fluid and dynamic, and people will hopscotch around. Oh, Mag 7, no DRAM, no memory, no, I'm going to analog semi, but it's all within sort of the same pool of stocks. So I think that has definitely happened. What we have not seen is people saying, oh, no, I'm just going to get out of semis and go into software, other than a day or two. It'll happen for a day or two really quickly, and then that'll sort of like dissipate pretty quickly as well.
All right, Stuart, you're going to stick with us. We have to discuss earnings, too, with yesterday unofficially kicking things off. We are just moments away from your opening bell as stocks fall 1/3 of 1% for the S&P 500, falling 2 consecutive weeks of gains. After this commercial break, your opening bell. Just seconds until we begin your trading day. You're watching Bloomberg Open Interest. I'm Dani Burger. 2 consecutive weeks of gains. We're certainly starting on the back foot when it comes to Monday's trade. Nasdaq, that's down more than 1% in your futures trade. SK Hynix having a really tough go of it in the Korean trade after the cross listing on Friday. S&P hanging tight, trading down by 0.3%, while the Dow Jones is little change. We have Wisdom Tree. They make a lot of ETFs. 2020 vision, 20 years. I'm going to guess it's their 20th year anniversary, ringing the bell at the New York Stock Exchange. And meanwhile, we have Pegasus down at the Nasdaq. I think they do something AI related because everybody does, it seems, these days. So that's what's happening down at the Nasdaq. Meanwhile, SK Hynix, let me show you what the ADRs are doing this morning, because again, we had a historic tumble down in Korea. We're just talking to Stuart Kaiser about this, the kind of high beta nature of SK Hynix, the bleed over to the U.S. trade. Again, I thought it was very interesting, his comments, that now that you have American hours trading, that you bring in more liquidity, and maybe it won't be as volatile. But for now, we're down 8.2%, Fani.
All right, Dani, the AI trade under pressure, as you've been saying, ahead of second quarter earnings results starting this week. Now, TSMC reported a 36% quarterly jump in sales as demand remains strong. We'll get the full data from TSMC Thursday.
All right, and we're back with Citi Head of U.S. Equity Trading Strategy. It is Stuart Kaiser. Stuart, I was just looking through some of your research about what options are implying for this earnings season. It seems that we are implying less of an extreme move this time around, which in itself seems surprising given earnings expectations are so high. We have one day where like 5 banks are reporting tomorrow. It seems like there is, I don't know, odds that we will get something of a volatile earnings season.
Yeah, I mean, I think that has to be your base case. If you look at last quarter, 60 out of the S&P 500 stocks moved more than 10% when they reported earnings. That is a stunningly high number. If you went back 4 or 5 years, that number would have been 10 or 12. So single stocks are moving a ton. It's been a little hard to identify, which ones those might be, obviously. The implied moves this quarter are lower than last quarter, but last quarter was also a record high. So the market is still, I think, expecting a tremendous amount of volatility this quarter. quarter, and as they should. I mean, the bar has been reset materially high after last quarter. And as we've discussed, I mean, you're kind of on a knife edge on a lot of these stocks. And if you look at, Broadcom recently reported, Samsung recently reported pretty strong results if you just saw the numbers. And those stocks still moved 8 or 10% on earnings. So the bar is high and the positioning risks are substantial and people are very aware of it. So the implied move is maybe not what it was last quarter, but it is still very, very high historically speaking.
The Russell 2000 up 20% year to date. Are the gains in for the Russell, given that we really don't know where interest rates are going and they might be a little bit more sensitive to interest rate increases?
And to your point, they may be more sensitive because it's a new index, basically. At the end of June, we rebalanced the Russell 2000, and a lot of the top end of the Russell 2000 had basically become AI stocks. And those are now in the Russell 1000. So if you look at the Russell 2000, the top 10 stocks were about 7.5% of that index at the end of June. Those are down now to about 3.3%. So basically, you've cut the concentration out. And the implied volatility of those top 10 stocks has gone from 90 to 50. So I would argue that the Russell 2000 right now is not the Russell 2000 of 2 or 3 weeks ago. But to your point, I do believe it's actually going back to how we would traditionally think about small cap. It should be more rate sensitive. It should be more sensitive to U.S. economic growth because we've taken some of that AI trade and moved it up the cap structure and left the rest.
Wait, what I'm hearing for you is more reasons to go back to not loving the Russell 2000.
Well, it depends. If you think inflation's going to print, well, I mean, Mike was talking about if we get a light inflation print tomorrow, maybe you get Russell moving. For me, it's actually a really positive thing because you want the Russell 2000 to express a view that's sort of independent of what the S&P and the Nasdaq do. And I would argue the rebalancing has moved the Russell back into its more kind of traditional envelope of risk.
Every time we see hostilities flare up in the Middle East, and it's clear we're not done. We may have thought we were at one point, but we are not. Do you worry a lot that this could spark something very, very serious in the market?
It's all about the price of oil, I think. I think the equity markets, if you go back, as far back as the initial attacks on Israel, the equity markets are generally saying this is an oil trade for us. If oil gets high enough that it taps us on the shoulder, then we're going to start paying attention. If that doesn't happen, equities are going to focus back, I think, on the AI and CapEx story. So from here, I think you would need oil back into the mid-80s or higher.
But you could easily get that, Stuart. I mean, if tanks are low and the glut goes away and the strait's still closed, then what else happens?
Yeah, well, I think what the equity market is telling you is they believe both sides of this do not want to do that next step of escalation. And unless that happens, we're going to focus on the $1 trillion in CapEx. But look, from an equity perspective, this is about oil. From an economics perspective, this is all about the price of gasoline. And the national price of gas is back below $4, which is incrementally positive. So it's a tail risk. I don't disagree with you. But I think you need a tail type outcome in the price of oil to really get equity markets' attention again on Iran.
Yeah, we already lived through this and demand came down and everything was more or less okay. But we have seen earnings upgrades for energy and for tech stocks. It really seems to be the bulk. And a lot of people have cited the number of 20%. Earnings expectations higher by 20% year over year. Stuart, how high exactly is that bar? Is this something we always beat it? Is it going to happen again this quarter?
Look, the bar is obviously very high this quarter after a tremendous beat last. My guess would be we get a beat of the numbers, but it looks more like traditional, like you're kind of, 5 to 7% type beat. But again, it's going to come down to that CapEx spend because that just trickles down, kind of the rest of the market. But yeah, you're going into this with a higher bar, no doubt, but also with very, very strong spending intentions. And I think in for a penny, in for a pound for a lot of those companies. And for that reason, I think ultimately this will play out well. For banks this week, it's a pretty good operating environment for banks right now. Very good IPO pipeline, very good trading environment. CCAR and et cetera went pretty well for the banks as well. So we do think banks are going to report well. And then, you mentioned banks and inflation. Later in the month, we get the FOMC and tech earnings again. So talk about a big day. You get to the end of July, is going to be some really big days for the market.
Stuart, what percentage of people that you speak to or that call you every day have already moved on from earnings season and are already talking about midterms and what happens after that?
Midterms, there was some interest in it a week or two ago on the view that with Iran risk coming down, to your point, Trump is going to refocus on domestic policies, and folks were looking for how do I get exposure to that? How do I get exposure to the affordability theme or to the domestic growth theme? XHB and home builders was one sort of talking point there. That's going to get put on pause a little bit just because of earnings. As I mentioned, you have these are $1 trillion stocks moving 10% on earnings. It's very hard to focus on the election when your portfolio is moving that much. So I think we had a little bit of focus on the election. Probably for the next 2 weeks will be earnings again, and then back half of July into early August. Other than SpaceX, I think hopefully we'll focus on midterms.
We're not going to get a quiet summer, are we?
No, definitely not.
That's so disappointing. But we haven't had a quiet summer in a very long time, so maybe that checks out.
The World Cup will end. You'll get more sleep, and it'll all be good.
No, that's going to be a sad day for me. Stuart, thank you so much for joining. Such a pleasure to see you. That's Citi Head of U.S. Equity Trading Strategy, Stuart Kaiser. All right, just under 8 minutes into your trading day, let's get a check on this equity market. Again, we're off the back of 2 consecutive weeks of gains, but this is an S&P 500, which in today's session is being dragged down by chip stocks. A lot of the Mag 7, though, having a pretty good day. Again, it's this back and forth that we've seen volatility between the 2 trades where Apple, Microsoft, Amazon, they're doing well. Energy companies also having a good day, considering what is happening in the Middle East with the Trump administration, or Trump himself speaking on Fox, saying that they will take control of the Strait of Hormuz. So large disagreement of the status of the strait, whether it is open or closed. So Chevron, Exxon, all of those doing well. We also have some of the big financial names, Visa, MasterCard, having a good day too. To the downside, again, it's the chip makers, Micron, erasing 8.5 points from this S&P 500 itself, which is down 17 points. NVIDIA, that falls 1%. Broadcom, AMD, SanDisk, again, look at all these names. It's just a lot of chip names that are in the decline column. When it comes to this overall market, again, tech under pressure because of what's happening with the chip makers, and that is the worst performing sector today. It is down 1.2%, but there's not a lot of declines. Again, this shows you just how poor breadth is and how just the chip makers falling are able to really upset the entirety of this index. Energy having a good day. Again, the price of Brent crude moving higher. Utilities, consumer staples, real estate follow closely by. Healthcare also having a not so good day with a decline of about 1/3%. Coming up, we're going to gear up for the mega bank earnings day that will be occurring tomorrow. Hold on to your seats. 5 companies go at once. KBW's Chris McGratty. We're going to talk with him about what to expect from those big banks tomorrow. You're watching Bloomberg Open Interest.
All right, it's time now for our top calls. Some of the analyst action in focus this morning, and we're going to start with Wells Fargo saying Disney is not built to compete with Netflix or YouTube on streaming volume, and argues the stock could have a 40% upside if the company exits the streaming business. The firm says Disney's library could generate more than $15 billion in annual licensing revenue without hurting its box office, experiences, business, or its brand, and that stock up more than 1%. Next up, JP Morgan raising its rating on American Express, saying its affluent customer base and defensive revenue stream make it better positioned as geopolitical risks rise and lower income borrowers face more pressure. And finally, we have HSBC upgrading Capital One to buy, saying the bad news is already priced into the stock. The firm sees earnings picking up as the Discover integration moves forward over the next couple of years. Dani.
Vonnie, that upgrade comes just ahead of a pivotal week for bank earnings. 5 of the 6 largest U.S. banks are set to be reporting tomorrow. Joining us now is KBW Head of U.S. Bank Research, Chris McGratty. Chris, thanks so much for joining. Great to see you in what I'm sure is the last calm day of the week for you.
Exactly. Let it begin.
Let it begin. Look, capital markets activity is booming. The consumer looks largely healthy. We've had record M&A volumes. Is there anything not to like this earnings season?
There isn't, but that makes us nervous, right? Expectations are high, right? The banks, the big banks in particular, have outperformed for good reason. The fundamentals are, excellent. Earnings estimates are up 15% from a year ago, and the stocks are up 30%. So expectations are high, the bar is high, but we think they will deliver.
So how will they guide? Because sure, this volatility can continue, but it's been particularly spectacular, right? How will they guide in terms of, FICC trading, equity trading, deals, everything?
That'll be, intra-quarter. They generally don't go too far out. But I would say, broadly speaking, we've been on the good side of volatility, right? If you go back in time, we'd ask ourselves when things like Iran and the war happen, who's going to get stuck with some bad trading losses? For the most part, the banks have ended up on the good side of volatility. So trading results, we think, will be up 15% year on year. Investment banking, we're going to hear about pipelines. So that'll be the outlook commentary. We heard last quarter they're at records, and we want to hear that follow through.
We've had a lot of the big deals already come into this market. Is it your assumption that we are still in this era of mega deals and that the banks are going to be capitalizing off of that? Or will we see some smaller things come through the pipeline that can still support the record volumes that we've had thus far year to date?
Absolutely. The big deals are getting the attention. There's plenty in the pipeline. And I think, beyond just the transactional nature of making, $100 million in SpaceX, is the trickle-down effect. So managing the wealth and managing the money of these companies and these individuals, that's where you get the permanency. That's where you get companies like Morgan Stanley. Yes, they'll make a ton of money this quarter on these IPOs, but it's the longevity. And as an analyst, we look at the persistence and the repeatability of these revenues.
Who will give us the most color on deposit costs?
I mean, Bank of America and JP Morgan are the numbers 1 and 2. I would be listening the most to them. I think as you get through the week, you'll see the regionals talk more about outlooks for deposit costs. That's the second major theme. The number one theme, we talked about capital markets. The second theme is just the outlook for deposit costs. Because for the traditional bank, net interest income, net interest margins are 70% of your revenue. And if the second derivative or flatlining of deposit costs are happening, you're going to have to really think about the outlook into 27 for margins. Are we at a point of inflection and perhaps rolling over?
Well, how much is that complicated by, I know you and the team's view is that we're not going to get cuts this year nor next year. How much pressure is that adding on?
On the margin, it's more difficult, right? The good thing is the assets are still repricing higher. So the margins are still, up, steady to up. I think as you go into 2027 budgeting season and looking at next year, I think if we see stable rates, you're going to see deposit costs creep up. And I think the stocks will trade on that.
So talk to us a little bit about where you're expecting the bar to be a little bit higher and be met as opposed to perhaps disappointing. So I know some of the regionals, for example, you're looking for really nice performance.
The regionals are set up to make a lot of money, right? The mid to high teens ROTCEs. What we haven't talked about is credit quality. Last quarter, it was private credit. That is absent from the conversation right now, which as an analyst makes me a little nervous.
Wait, why is it? Because they still have been really tied to the booming data center debt that's been taken out. And we've seen stories of banks trying to offset some of the exposure we have. Why won't that be present in this conversation?
I think it will be. I think we'll have to dig a little bit. But I think in general, analysts, investors focus on one or two things. And those two things we talked about, deposits and capital markets. But I think in terms of what could wreck the rally, what could really deter confidence, it's any conversation around credit. And so this higher for longer narrative, that has the potential over time to weigh on credit concerns. So higher rates make it a little bit more difficult on credit.
So at the same time, I know that you also like Morgan Stanley over Goldman Sachs heading into the earnings season. Why is that?
Well, first off, they're both excellent at what they do, right? Goldman is the number one in investment banking and trading. Morgan Stanley's got this powerful $10 trillion wealth management business. Our difference is really what you, in terms of repeatability, we think Morgan Stanley's business model deserves a higher multiple. They're both trading at very high multiples. Goldman at 3 times book, Morgan Stanley at 4 times tangible book. But it was more just a nuance. They're both going to have blowout quarters. I think there's probably more likelihood that Morgan Stanley's earnings beats run rate into earnings projections going forward, but they're both going to have outstanding quarters.
For Citi, Bank of America, JP Morgan, Goldman Sachs, we're talking about a 20 to 25% gain year to date, right? You think that's not really pricing them fairly, that perhaps there should be more gains there?
They're expensive by historical standards, right? The largest banks are trading roughly 13 times next year, and the smaller banks are trading at 25% discounts. You go back in time, that was flipped on its head, right? The small banks would get a growth premium, the large banks would get a regulatory discount. We think because of the regulatory momentum that's apparent in the system right now, and the repeatability and the scale that these large banks have, we think they deserve high multiples. And when you think about it broadly, outside of the bubble of financial services, 14, 15 times earnings isn't that expensive compared to other sectors. So it's uncomfortable as a bank analyst to put a 15 or 16 multiple, but they are growth companies in some capacity.
We had heard for Diamond saying in May, late May, he basically said, we are on the lookout for deals. We're on the lookout of adding more capacity for JP Morgan. Do you think that there are a lot of opportunities out there? Do you look around and maybe some of the smaller, the regionals, and see, yeah, they're real M&A targets for some of the big players right now?
There's no holes in JP Morgan's franchise, right? They are at scale in all their businesses, technology, investment banking, depositories. They can't buy another bank because they're above the cap. Sure. Could they fill out the wealth management, asset management, payments? Absolutely. So could some of their peers. But I think broadly, the regionals, they are scale buyers, right? They are looking up in terms of scale. They're doing a great job, but we are at a moment in time where the regulatory world is allowing banks to do deals, and they're allowing them to do them quickly. And I think they'll capitalize on that.
Just want to let everyone know, so you love PNC among the super regionals, Flagstar, Popular, Hancock, Whitney among the SMIDs. You have downgraded First Citizens.
First Citizens is a name we stepped aside from this quarter, and those were all calls into the quarter, the PNCs and the likes. First Citizens is the #1 bank in terms of regionals that has grown tangible book over a 1, 3, 5, 10. So they are working for shareholders every day. Our decision to step aside was really based on the conversation earlier about deposits. They have a nuanced headwind from the SVB acquisition a couple of years where they have to pay back the government. And so they have to raise more deposits more quickly and at a more expensive rate. So that's impacting the margin outlook a little bit. But again, great company, very cheap valuation, continuing to buy back stock.
All right, Chris, you better get home, get some sleep.
Great.
You're going to have a long day tomorrow. That is Christopher McGratty of KBW joining us. Coming up, Delta CEO Ed Bastian says his airline will do just fine with higher fuel prices. More from that interview next. This is Bloomberg Open Interest.
Welcome back to Bloomberg Open Interest. A check on your equity market about 20 minutes into your trading day. And just keep in mind where we're coming from. 2 consecutive weeks of gains, a lot of enthusiasm over SK Hynix listing in the U.S. on Friday. Even the chairman telling Ed Ludlow, when things calm down, we're going to be issuing more shares. Today, my friends, is not that day. The Nasdaq falling more than 1.5%, being led by chip makers. Look, nothing specific out there. No news that would necessarily derail this trade. But considering we are trading more risk off, it has become a high beta play. The S&P down by 0.4%. The Russell 2000 also down by 0.33%. Stuart Kaiser pointing out that the Russell 2000 has become more of an interest rate play because we had a rebalancing and a lot of the AI names went up into the Russell 1000. So thus you have something that's more interest rate sensitive. And it makes sense why you'd get some interest rate sensitivity today. Yields are moving higher with the price of oil moving higher too. I don't see oil on this board unless I'm going blind, but the price of oil is moving higher today. I can promise you that. Gold, that is falling by 1.7%, as is Nvidia. And again, look at these huge declines in the chip makers. SanDisk down 10.4%, Micron 6.5%, SK Hynix, the US ADR is down 6.9%, not as bad as the South Korea session. Much more leverage in the system there, although we are getting more of these ETFs coming to America. Carnival, that is surprisingly higher by about 0.33%, but most of the travel names are off today. Given the price of oil continues to climb over uncertainty in the Middle East and the status of the Strait of Hormuz, Delta Airlines among those declining down 0.6%. And of course, they had their earnings last week. They beat expectations, but the shares had fluctuated on their outlook. And Delta CEO Ed Bastian says that higher fuel prices, though, they're not deterring travel. He spoke with Lisa Abramovitz earlier on Bloomberg Surveillance.
Our consumer has the ability to sustain this level. In fact, we saw it in the quarter. We made at 9% operating margin with fuel prices much higher than where they are in the existing, the existing landscape. So I think oil is going to stay sticky for longer. I'm not sure it's going to be in crude, though. I think the refined costs or cracked spreads are where you're going to find it's going to take a lot longer for that to come down. Our international, travel season is looking very, very healthy. Businesses, international, as I just said, American Express, our loyalty programs, our cargo business, we have so many different lines of business, including here in the U.S., our domestic travel. It's all doing very, very well, and I don't see fuel prices deterring that.
Delta CEO Ed Bastian on surveillance there speaking with Lisa Abramovitz. And it's incredible, Dani, how optimistic he sounds. They've really ridden out this quarter really quite well. And if that was the end of it, great. But it looks like we might be kicking off again.
Well, the thing that's good news for Delta is the fact that they've really geared their business to be one that's premium. They've really lent into business now, also having basic business, which I hate, and I could spend an hour on why I think that's horrible. But they are more immune. Their consumer is more immune. Even if oil prices go higher, we have seen people continuing to travel if they're able to afford it.
They have pricing power, and that's what this market is all about, whether it's from the memory chip makers to the airplane to the cruise ships, right? Do you have pricing power?
Yeah, certainly. Coming up in the next hour, we're going to continue the conversation on the economy. RBC economist Francis Donald will join us in a very busy week, along with a lineup of power CEOs. "30 minutes into your trading day. Welcome to Bloomberg Open Interest. I'm Dani Burger alongside Vonnie Quinn. It's a market that's being struck by lower tech, lower chip makers, SK Hynix's worst day ever in the South Korea trade. And we begin the show with that tech turbulence. SK Hynix leads a chip sell-off with a packed week of bank earnings and inflation data ahead.
Fresh strikes driving up oil prices too as President Trump vows to take over the Strait of Hormuz.
And as the AI power race heats up, we're going to hear from the CEO of Sunrun, the CEO of Jeff Bezos-backed General Fusion, plus Lazard's global head of power. We begin, though, with a busy week ahead. U.S. CPI is due tomorrow. Then we're going to get Fed Chair Kevin Warsh kicking off his two-day testimony on Capitol Hill. We'll get PPI. We'll also get retail sales and big bank earnings. Joining us now is RBC Chief Economist Francis Donald. Francis, really wonderful to see you. Let's just start with CPI. What are your expectations for what the data delivers and how far forward we can carry it, and if it is somewhat based on the price of energy coming in?
Well, of course, energy is a big reason why month over month inflation is going to look a little bit different, but that's not the story here. The story is not energy. It is what is happening with services inflation. Every measure of services inflation that we have is just too high, most of them above 3%. Even Fed Warsh's famed trimmed mean is in the high twos. We have to move away from the idea that energy was ever the problem. It's a problem, but the real issue is this uptick in demand-led inflationary pressures, the old-fashioned ones, Dani, that we used to worry about back in the day. And those are the inflation measures that the Fed cannot ignore. So while there'll be a lot of attention on CPI, which will look a little bit better on the headline, I want to see what's underneath the surface.
So, Francis, what will be the transmission mechanism the Fed will use to try to work on services inflation in particular? Will the consensus be that you can do that with maybe shrinking the balance sheet?
That's going to be a far-fetched for Kevin Warsh, I think. So the issue is going to be paying attention to some of these other indicators. I mean, we have an economy that is running at 2%. There's a significant infrastructure build-out, but we also have a very tight labor market. The unemployment rate at 4.2%. If I told you 10 years ago we'd be at 4.2%, you'd think the Federal Reserve would be hiking into that environment. So there's a lot of pressure underneath the system that is suggesting this is resilient growth that is supporting the broad economy, and an economy you don't want to bet against. I think we are often asking when we look at this data, what does this mean for the Fed? And of course that does matter, but we should also be asking, what does this mean for businesses that need to have, as you mentioned earlier, Vani, pricing power? What does this mean for companies that need to put forward earnings? And I think as I look at the inflation data this week, I'm going to be focused less on what does this mean for Kevin Warsh and what does this mean for how businesses are going to be able to price out a consumer that's feeling a little bit more inflation pressure than they were at this time last year.
I understand the data matters less for the Fed, but Francis, it's still even more complicated, and we don't totally understand how this Fed will be reacting to the data, given that this is a Federal Reserve Chair, Kevin Warsh, who doesn't want to give that forward guidance or detail any of that. We're going to hear from Chris Waller today, along with, I believe, 14 other speakers from the FOMC this week. Is that how we understand the reaction function? Do those speeches become all the more important because of the restraint coming from Kevin Warsh?
There's going to be an enormous amount of focus on the Fed's response function. But if you listen to Kevin Warsh, he told us, go back to the fundamentals. Think about what the data means for the economy first. And that's what we're trying to do. If inflation is too high, is it putting pressure on consumers? If it's putting pressure on consumers, it's going to put pressure on businesses that are serving consumers. That's the fundamental question in play. And moreover, as we think about broad market reactions, what it means for everything from equities to bonds, we should also be thinking about, is this an environment that's going to create challenges that weigh on these companies? Not is 25 basis points going to make a huge difference.
Is Kevin Warsh going to make the argument that it's okay, AI is going to fix everything because productivity is going to increase substantially?
Certainly, that's a question that's going to come up to play. So too is energy. And he should also be watching food costs in this environment. We have more upside ahead on those factors as well. And fundamentally, when we think about inflation in the second half of this year, we're still much more worried about upsides than we are downsides. AI is one of those stories.
It's remarkable to look at this jobs market that continues to hold up, Francis. And I just wonder if hiking rates is now divorced from the jobs picture, just given that this economy and this jobs market is not as concentrated in industrial sectors as it once was. Do you think that will still be a present conversation, a reticence to hike because of what it does to the labor market? Or again, has this economy moved on?
I think you've put the nail on that. It is about an acyclicality that is coming through in this labor market right now. This is a labor market that is very healthcare centric. Most of the jobs coming through from structural changes, AI. It is not one that is as best of an indicator of what's happening in the cyclical economy than has it been in the past. So how we as economists, how we as central bankers, how we as businesses respond to it has to change in an environment where it's no longer do consumers have jobs, it's are they making enough money in that job to pay for this cost of living.
Will the midterms have any impact on what the Fed chair decides to try to convince the rest of the FOMC of?
Out. I think you're going to find every central banker in the world is going to say it is absolutely irrelevant. In fact, that's the angle that they're going to try to take in that. But does the midterms change the path of fiscal policy? Does matter. If you get more fiscal policy, it is more inflationary, and the Fed may have to lean against that. But it's still early days. And of course, much of what's happening on the fiscal side now is just continued upward pressure on the economy. Does the magnitude of that change at the midterms? That's a question we can start asking. But does it change the bias or the decision-making function of the Federal Reserve? I think almost all central bankers would push back against that.
Francis, when it comes to the state of the consumer, we get retail sales, but we also get a lot of the big bank earnings. Are you going to be paying attention to those? What are you looking out for to kind of understand where we are at this moment?
Oh, we get bank earnings, we get NFIB small business optimism, which is going to tell you more about what's happening with labor demand. We're going to get a ton of housing market this week as well. You got Philly Fed, Richmond manufacturing data comes through. Economists have a lot of questions about how much more this consumer can take, and hopefully the data that we see this week gives us answers. But there's certainly a huge mosaic of information that's going to be coming through, and it's going to be putting those stories together from how much inflation is still in the system, how much more can consumers take, how will the Fed react to that, and how is it impacting businesses from banks all the way to consumer stocks? That is what's ahead for us this week. So certainly lots of information. We'll have to dissect it one piece at a time.
Just your average sleepy summer week. Francis, thank you so much for joining us. Really great to see you, Francis Donald of RBC. Let's get a check on your markets ahead of that very busy week. Again, Francis outlined it all there. We get earnings, a lot of data, a lot of Fed speak, and we also have to contend with what's happening in chip stocks. It seems to be bowling around this market. The Philadelphia Semiconductor Index down 3.6%. That drags down the Nasdaq down nearly 1.5%, whereas the S&P is down by a third. Brent crude, that higher, Vani, by 3% this morning.
Yeah. It's coming off its highs. Let's get a look at some single stocks moving at this hour. Dani, SK Hynix ADR is falling after the chipmaker's historic U.S. listing Friday. The Korea-listed shares posted their worst decline ever.
Meanwhile, TSMC did report a 36% jump in quarterly sales, and the latest sign that global demand for AI computing remains strong. Initially, shares were trading higher, but now starting to fall with the rest of the AI trade.
And watching energy, of course, as oil rises on renewed strikes between the U.S. and Iran. President Trump telling Fox News this morning that the U.S. is taking over the Strait of Hormuz.
For more on the Middle East, Bloomberg Washington correspondent Tyler Kendall now joins us from the White House. Tyler, there does seem to be widespread disagreement as to the status of the Strait of Hormuz after renewed escalation over the weekend. What do we know?
Dani, at this point, we saw a trade in attacks over the weekend, and then today we're seeing a trade in heightened rhetoric between the two sides. Earlier today, President Trump maintaining that the U.S. will guard the Strait of Hormuz in his words, and seemed to imply that there could be some sort of longer-term commitment by the U.S. when it comes to the waterway, saying that the U.S. would want to be reimbursed down the line for helping to secure safe transit. Now, Iran has disputed that the Strait of Hormuz is opened, even as CENTCOM puts out some numbers saying that they are still helping guide ships through the Strait of Hormuz. It's hard to track it at this point because we know that observable crossings, when ships have their transponder and radars on, is hard to track at this point according to satellite imagery. But our analysts at Bloomberg Intelligence looked at the data, and they say for the past 3 days they have seen an uptick when it comes to those so-called dark crossings, exceeding the number of observable crossings for the first time since the Memorandum of Understanding was signed last month. At this point, we have to see where it's going to go from here. Iranian state media has been out with some pretty tense statements this morning saying that they will dispute any U.S. interference in the Strait of Hormuz, as we know that more of those vessels were looking to take that route that is coordinated by the U.S. and hugs the coast of Oman. Vani and Dani, at this point, it also seems like Iran is reaching out to some of its regional allies. Importantly, we saw Iran's foreign minister hold a meeting with Oman over the weekend, which is something to watch for sure, as we know that those two countries have previously said that they would be looking at some sort of framework to basically oversee transit when it comes to the Strait.
Tyler, can I ask you about domestic policy for a moment? I mean, while being mindful of the fact that a senator has just died and, without any notice, there is going to be a rush to try and fill Senator Graham's seat, right? There's a lot to be done. The Save America Act, transportation, farm programs, all sorts of defense spending and so on. What happens next?
You're right. There is so much to watch here, Vonnie, with the passing of Senator Lindsey Graham. When it comes to the domestic agenda, Republicans now have a 52-47 majority, and it's made even slimmer by the fact that Senator Mitch McConnell isn't right now voting due to his own health concerns. There's so much on the agenda at the moment. Keep in mind that Senator Graham is the head of the Budget Committee, and he really helped to shepherd through the legislative priorities that we actually saw get through this Congress, perhaps most notably the One Big Beautiful Bill. There have been questions here about whether or not Republicans will pursue a third reconciliation package, though that, of course, faces an uphill battle. But that seems to be something that was put on the table in order to get provisions of President Trump's Save America Act, that voter ID law that he's essentially hinging all other priorities on. That's the domestic agenda. We also know that Graham, of course, was on the Senate Judiciary Committee. The Attorney General, Todd Blanche, has his confirmation hearing this week. That could also potentially be slowed down now that there is not that vote in support of him for getting out of committee. And then lastly, Vonnie and Dani, of course, on the foreign policy front, Lindsey Graham was known to be this defense hawk when it comes to foreign policy. Questions here about what that means, particularly when it comes to aid for Ukraine, considering that he had just completed his 10th trip to the country over the weekend since the war began.
And we're all just remembering a remarkable career from the late senator that spanned decades, both in the military and public service. Tyler, thank you so much for joining us. Bloomberg's Tyler Kendall reporting from the White House. Coming up on the show, Sunrun is taking a step beyond solar rooftops in a venture that could turn sun-powered homes into a mini AI data center. We're going to get the details from Sunrun CEO Mary Powell. This is Bloomberg Open Interest.
Now to high interest to look at what's making headlines around the world. Wall Street is quietly preparing for a deepening Saudi-UAE split that could disrupt trillions in Gulf investment, pressure oil prices, and complicate business across the region. Banks and private equity firms are drafting contingency plans and reviewing contracts as political tensions increasingly spill into commerce. Shein is targeting a Hong Kong IPO as soon as next month after winning approval from China's securities regulator. The fast fashion giant could raise $2 to $3 billion, making its third attempt to go public after failed listing efforts in the US and in London. The NFL just got a new billionaire owner. Tech investor Vinod Khosla is buying the Seattle Seahawks in a deal reportedly worth $9.6 billion. It's a price tag that would shatter the NFL record, dwarfing the roughly $6 billion sale of the Washington Commanders just 3 years ago. The blockbuster deal still needs NFL approval, Dani.
Such a high price tag, and you got to wonder if it's the top. I mean, they just won the Super Bowl. Where do you go from here? Anyway, elsewhere, the solar energy company Sunrun is making a move into AI. The company is launching a pilot that uses its network of homes with solar and batteries to help AI computing power. Joining us now to explain is Mary Powell, the Sunrun CEO. And Mary, great to have you on. Look, it's quite novel, this idea that you basically will pay homeowners to power many little AI data centers directly into their homes. How does this actually work out? Like, will you own the computer processing network? Does the homeowner own it? And how much money could they realistically get from this?
Well, first of all, it's so nice to chat with you. And this is a really important development. I mean, we are all about serving over 1 million homes across America and helping them generate their own electricity. So we provide the ability for customers to generate their own electricity, to store their own electricity. And now, as we think about distributed compute and we think about the fact that the need for energy is hitting all-time highs nationally, demand is expected to grow 40% over the next decade. And at the same time, we know that AI compute needs energy, needs power on top of that. So one of the things that we found is that we could really potentially be a really important part of that solution with our customers by providing their homes with nodes that then allow them to, in essence, provide mini data center capabilities and get compensated for that. So to your point, the customer would host it and the customer would then get paid for the value of meeting that demand, that AI demand.
So what are the financial terms of any agreement with, customer A, Mary?
Well, again, we're doing this as a pilot. So we're starting with, a pilot program with customers. And we wouldn't be doing it if we didn't think, obviously, that it's something that could really take off. And the values, could really range. I mean, it could range from a couple $100s to more than that in a month, depending on how much that node is needed. Because, again, they're not providing power from their home. What they're doing with that node is actually providing the answers, the AI answers to questions through that node in their home. And again, we provide them the ability to generate their electricity, to store their electricity, and to become so much more in the driver's seat around how they generate, consume, and use energy. And so what we want to do is give them another way to use that energy if they choose and to get compensated for it.
I'm like envisioning this future where AI has replaced all of our jobs, but we're still making money because our homes are now AI data centers.
So is Kevin Warsh.
Yeah, it's true. So I'm feeling, I kind of see the future of where we're going, Mary. What about contracts for what you're going to do with this compute, with this capacity that you have? Have you already been talking to like any of the tech giants to maybe sell some of this specifically to them?
Yeah, we're having a number of conversations with potential off-takers. There's a lot of excitement in this space, as we all know. And there also is a market for this kind of demand. So that's all part of why we want to do this really extensive pilot so that we can learn, develop it further, and really scale with it.
Mary, subscriber additions were down about 25% in the first quarter. What are you seeing in the most recent quarter?
Well, we are continuing to progress on all the things that we said we would do. And we're really focused, again, on the right kind of growth. That is why Sunrun is the strong one in the space. And we are the vertically integrated operator that is providing incredible energy independence and control for Americans all over the country. So we're really pleased with the growth that we're seeing. It's exactly as we set out to accomplish. And
has demand really picked up then, though, Mary?
Excuse me?
Has demand picked up then? Is that what you're saying?
Demand is really strong for the product. Make no mistake, the demand for what we're selling has never been more intense. Utility rates are rising, reliability is going down, and what Sunrun provides is a way for customers to have control and independence.
Mary, sorry, if I can just jump in, because it's hard to ignore that maybe the market doesn't fully buy it. Your shares are down 33% year to date. You did have your partnership with Tesla and Renew Home that kind of helped pick things up, but it does feel to be this deep skepticism, whether it be about your big debt load or this narrative that you're becoming more of an AI company. What are you going to do to convince this market that this demand, this change, this pivot to AI, that it is real?
There's been a lot of volatility in our space, for sure. And what is so important is to just continue to do what we've done, which is focus on what a great company does. And a great company provides incredible products and services to customers. A great company generates cash and makes sure that they're doing it in a way that is profitable, and a great company innovates. And what we're talking about today is the additional innovation, which is value on top of what we already provide customers all across the country and what we already create for Sunrun.
All right, Mary, thank you so much for joining us. Mary Powell of Sunrun. And we're going to have more on powering AI ahead. A all-star lineup of executives to speak on this. The CEO of Jeff Bezos-backed startup General Fusion. Plus, we'll hear from Lazard's global head of power, energy, and infrastructure. I want to bring you some breaking news coming from the president on Truth Social. Speaking about the Strait of Hormuz, saying that he is reinstating the blockade against Iran. Again, posting this on Truth Social, saying that the Strait of Hormuz is open and will remain open with or without Iran. We are reinstating the Iranian blockade, so named because it is only stopping Iranian ships or customers from entering or leaving. All other countries will have fair and open use over the Strait of Hormuz. Trump also saying that the U.S. will be reimbursed 20% on cargo shipped through the Strait. Vani, the detail is missing, and whether Iran will agree with this is missing, too. We know the Iranians in recent days have struck ships going through the Strait of Hormuz. The U.S. has tried to deter that with launching their own attacks against Iran. But the U.S. is saying this. It takes two to tango. Will Iran allow any ships through the Strait of Hormuz?
Well, I just wonder what he means by the U.S. will be reimbursed 20% on cargo from Hormuz. So who will be doing the reimbursing? Is it the shipper? Is it... I don't know. It sounds like a toll to me. Is that a toll?
Well, he certainly has, and there is this pile of money sitting that Iran is waiting to get back. And the U.S. said that they would be paying Iran, not directly from the U.S., but that would be going to corn and agriculture. Perhaps it's that lump of cash that goes to the U.S. Again, energy prices moving higher on that news. Brent crude up 5% more after this commercial break.
Let's get another check on oil following that breaking news. We did have Brent hit $80 a barrel after President Trump said the Hormuz Strait will remain open with or without Iran. He also said the U.S. is reinstating that blockade and that the U.S. will be reimbursed 20% on any cargo that goes through Hormuz. He said that the reimbursement will be at the rate of 20% and it will begin immediately, the U.S. being the guardian of the Strait of Hormuz. And as you can see, stocks not reacting too much to this, but certainly Brent, Dani, is higher.
Yeah, up by nearly 5%, 4.3% to be exact. I wonder where Europe stands on all of this. We're coming off the back of NATO and whether they would participate in any guarding of the Strait of Hormuz. Coming up, we're going to talk to General Fusion CEO.
Jeff Bezos-backed startup General Fusion is making its Nasdaq debut today, giving investors a new way to bet on fusion energy. The market, some industry forecasts say, could exceed $1 trillion a year by 2050. Joining us now is General Fusion CEO Greg Twinney. And congratulations, Greg. You're trading now on the Nasdaq GFUZ, and shares up 29% from the IPO price right now. What are you going to do with the proceeds?
Look, it's a totally exciting time for us here today. To be the first publicly traded fusion company in the world is pretty awesome. For us, getting to the public markets meant a whole bunch of things, but in particular, getting the capital that we could move the ball forward with our world-leading commercializable fusion technology. We did that with PIPE Capital, and we're pretty excited to be able to have that come into the company, which will fund our roadmap and some really incredible milestones in the next couple of years.
There are a lot of startups in this space, maybe even more than 50 that have been scrambling for funding. And you yourself, you talked about in 2025, about a quarter of your staff had to be laid off because of running short in funding. And I wonder, just for fusion companies, given how novel it is, given you haven't gotten to commercial viability yet, if you kind of have to go to public markets, if private funding has more or less dried up?
We've had great support from private investors all the way through. And so what we wanted to be able to do is advance the technology with that private capital to get us to a point where we have some real tangible milestones to fund as we move into the public markets. And so we built a machine recently called LM26. That machine is going to demonstrate some industry first milestones and move us really to the front of the pack. And so being first to the markets and the public markets allows us to access capital in ways that in the private markets don't allow for. And so we're pretty excited to be first. We're going to be able to sort of hit these milestones in the public markets, and that will bring additional capital in the future for sure.
Greg, in December, Trump Media and Technology did a deal and agreed to merge with fusion developer TAE Technologies, or TAE Technologies. Have you had any discussions with the administration? How interested are they in this technology?
Fusion is a game changer. Countries all around the world are racing to put fusion energy on the grid. It's energy security, it's an opportunity, and the export market for fusion is $1 trillion market opportunity. So it's huge. So to see TAE and others continue to raise capital or enter the public markets, I'm not surprised. It validates that fusion is now. It's happening. And I won't be surprised if others come to market as well.
It's not quite now, Greg? I mean, just the idea of when you actually get this up and running, estimates are anywhere from 2030 to 2035. So maybe we have a decade to go. Things like fission, that's already a large industry at this moment. So how do you convince one of the big utility giants, one of the tech giants, to partner with you, to invest on you, to sign any agreements when they could be waiting a decade at this point for power that they desperately need now?
Yeah, so there's going to be near-term gaps in terms of power to satiate the demand that's there. We see that every day in the news. You know, AI, electrification, industrial heat, these types of things are drawing huge amounts of energy from the grid. For us, we're thinking about stepping in with our first of a kind in 2035. That timeline's not that different from what you're seeing from SMRs. And so what that means is fusion can step in, play an important part in taking up the future growth of energy. And so, you know, fusion really can deliver clean, limitless, almost limitless energy. And so the opportunity is much, much bigger than that of fission. And now also a safety profile that doesn't have long-term radioactive waste, chance for a meltdown. You're not using fuels that can be weaponized. So it's a big difference.
So another one of your competitors, and sorry to talk about all your competitors, but Commonwealth Fusion Systems got some investment from NVIDIA and also Alphabet. Have you courted large public companies like that? Anyone interested in investing in you?
Yeah, we have some really great commercial relationships with a handful of utilities, industrial heat users all around the world. We work with them on a regular basis. And really what's important right now is to move the technology forward. That's the primary goal with us at General Fusion, move that technology forward. The markets are definitely being made. We have signed several agreements with potential customers of the future. But for us, move the technology forward. The market will be there. The demand for energy continues to grow. Those tailwinds, I think, are going to persist for quite some time.
And a lot of these large tech players are kind of building like power, their own private power resources. They build these data centers, and along with the data centers, they are building the power resources right next to them too. I know that's a huge appeal of fusion. You don't have to worry about those transmission lines. You can be right there. Is that how you're thinking of how you'll be constructing that? Maybe when we first see General Fusion up and running, you're going to just be right next to some of the big data centers.
Yeah, the beauty of fusion is that it's safe. When fusion fails, it fails safe. And what that means is that you can now place the energy right beside the demand. And you don't have to have a large exclusion zone or anything like that, because you're not working, again, with anything that has long-term radioactive waste or chance for a meltdown. And so being able to put that energy source right beside a data center or a city or anywhere else that, dense energy is required, that's the beauty of fusion. And that's why it's such a huge market.
You know, Greg, China ate everybody's lunch when it came to EVs in the end, right? And solar, obviously. And I'm curious, given that it's part of the 15th, five-year plan, are you concerned that China is going to do the same thing eventually with fusion technology?
There is a global race happening. Countries all around the world pursuing fusion, national labs, academia, private companies. We've been at this for 20 years, and so we've got a kind of 2-decade head start, and we're moving at a pace that is accelerating. And so, whether it's China or Germany or UK, it's great to see fusion being worked on in all these different countries. We're a Canadian company developing fusion right in Canada. We're excited to be on the Nasdaq. And what this all means is we're exporting the technology all around the world. And we've got a unique approach that's very practical, very economical, doesn't rely on superconducting magnets or lasers or any new materials. That's going to be a huge advantage as we move forward into commercialization.
And I know you have more of a mechanical approach. Greg, I've seen it called by critics as a steampunk approach to fusion, which I feel like is kind of a cool thing to say. I don't know why a critic would choose something so cool to describe what General Fusion is doing. But those critics would also say, look at some of the research that you've published. It shows that you don't get hot enough, that your components don't, to get the actual fusion that you need. What do you say to those that kind of push back against the technology itself, that it's not viable, not now, and it will take a long time before it's viable in the future?
Yeah, so to create a fusion power plant, you got to recreate the conditions of the sun inside of the machine, and there's lots of different ways to do that. We chose a way that uses mechanical means, so that we can use existing materials, existing type technologies, and not need to work with superconducting magnets or lasers or new materials. And so we just recently commissioned a machine called LM26. That machine is designed to achieve fusion temperatures, and recently we published and communicated that we'd hit 8.4 million degrees Celsius with that machine. And as we progress that program over the next couple of years, we aim to achieve fusion conditions. And then the path for us is simpler because we're working with mechanical means. And so it's actually a big advantage to be using steam and pistons, liquid metal, when it comes to commercializing the technology.
Again, I'm really thinking you should just adopt steampunk, embrace it, put it in your official marketing materials. Greg, thank you so much for joining us, General Fusion CEO Greg Twinney. Let's get a check on your markets over an hour into your trading day. Still trading lower, down 1.2%. Brent crude getting a jump after the president posting on Truth Social that they will be reinstating the blockade against Iran, just Iran specifically, while he says allowing other commercial vessels to pass through the strait. Still, though, dragging this market down as semiconductors down nearly 3% in this morning's trade, Vani.
Yeah, and let's get some individual stock moving at this hour. So if you look at Paramount Skydance, we're seeing it's up more than 3.33%. A dozen states or thereabouts preparing to sue to block Paramount from buying Warner Brothers, according to a person familiar with the matter. The antitrust challenge comes even after the deal received clearance from the Justice Department. Disney shares have been under pressure this year, but Wells Fargo says the media giant could see upside of about 40% if it exits its streaming video business.
Also in the world of tech, Meta committing to spending an additional $40 billion on its data center campus in Louisiana. That ups its total expected investment. Now it's above $250 billion for the site.
Coming up, Lazard says the cost of gas power in the U.S. is at a 17-year high. The firm's global head of power, energy and infrastructure, George Bilicic, joins us around the table next. This is Bloomberg Open Interest.
A new report from Lazard finding that the cost of power from natural gas-fired plants in the U.S. has now reached the highest level in 17 years. And prices are set to climb even further as demand surges from new data centers. Joining us now is George Bilicic, Lazard Global Head of Power, Energy and Infrastructure. George, thank you so much for joining us.
It's great to be here with both of you.
And a really good report, and I was struck by it's not just natural gas, it's things like solar too. The price is going up across the board. Is this just because of demand, because of AI data centers, or is something else behind the prices rising?
So it's a mix of demand, supply chain issues, the impact of tariffs, but we think chiefly demand, and the demand's flowing through equipment costs, but also labor costs. There's something that folks don't pay attention to that much is just the incredible need for labor around some of these projects.
Have we solved the energy crisis for data centers yet? I mean, weren't there all these various models that some were going to have them attached to them on site and some were going to use the grid and some, I mean, where are we on that?
We're a long way from solving anything in the area. I mean, it's going to be a topic of conversation for a very long time. There's tremendous need for power, and we really haven't begun to really address the problem.
And one of the things, again, that I found really interesting in this report is just that building new power infrastructure is difficult and expensive. I mean, you were just talking about the labor needs there. So existing infrastructure, the value of which goes up. But we've seen, to Vani's point, a lot of these big tech companies invest in new projects. Stargate, for example. Chevron has one in the Permian Basin. Google in NextEra, and I know that's a deal you worked on, NextEra specifically. I could go on. There's a lot of these. So why are you still seeing this huge investment being made despite the fact it is complicated and extremely expensive to get a new power source up online?
So you just, the data center ecosystem needs the power. These things are being built. They need to be run with electricity support. And there is almost an unstoppable trend line here where the power is going to be needed over time. We've been doing this study for almost 20 years. This is the 19th edition of the study. And we saw this tremendous ramp down in renewables costs. But even in the case of renewables, because of this demand pressure, costs have gone up over the last few years.
And storage costs are rising as well. Where are we on, being able to use things like, mini nuclear, reactors and so on? Like, we need different types of solutions here, don't we?
That's part of a big part of our study is that you need to be welcoming to all sorts of technologies. So renewables remain the cheapest resource. Natural gas is obviously critically important. And we think in this country, not in the next few years, but in the next decade, late in the next decade, nuclear will scale and will be really quite impactful.
And in the meantime, capital markets have been open for players that are looking for ways to fund this. Just earlier, there was a deal announced with Blackstone, a JV around power. And I wonder how sustainable you see that as capital markets, debt markets, what have you, remaining open, saying, yes, I know you're doing a lot of CapEx already on things like chips and memory, but we'll continue to supply the funding and spreads will remain well behaved in order to do that.
Yeah, the capital markets, the public capital markets are wide open for this space. So utilities have super liquid access to the capital markets. All energy companies do, established energy companies. And then the private markets have developed over time to allow for all sorts of different capital resources, insurance capital, infrastructure capital, and then private equity capital.
So your report found that the cost for solar rose to $69 a megawatt hour and onshore wind increased to $68, both up more than 10% from a year ago, the highest since at least 2014. When does the government need to step in? In China, the government stepped in and it fixed the problem.
Well, I think the place for the government to step in is in two areas. One, we need permitting reform to make it easier and quicker to get things built, but with respect for the stakeholder interests that are protected by permitting. So that's the first area. The second area, and the current administration is doing this, is trying to figure out a way to scale the supply chain to accelerate the construction of nuclear in the country. But there needs to be effort undertaken at the state level also, because probably these nuclear plants, large-scale nuclear plants, need to be built inside rate base, which is a state regulatory question.
And so trying to navigate that, again, the report underscores this, it's a lot of haves and have-nots. The gap between the winners and losers seems to be widening. Because of that, is the era of smaller scale independent energy providers, is it effectively over that the biggest players, because of their dominance and their ease of navigating, are going to be acquiring more small companies and less small ones are going to be starting up?
Yeah, there's a place for a lot of different things in the system. We do believe that our study tells us this, that there are benefits of scale and efficiencies associated with consolidation, and you'll see a lot of that in the industry. So for the ratepayer that's under rate pressure, it makes a lot of sense for there to be a consolidation transaction with utilities, because some of the benefits of the transaction could be shared with ratepayers. And you can see this in the renewables industry. There are a lot of small renewables players. They'd be better on bigger platforms.
How will LNG production be scaled up in the next 5 years in the United States? I mean, it's already been scaled up massively.
So there's a lot of places to build on the Gulf still, to expand on the Gulf, and then also in Western Canada. We think with the Carney administration, there's going to be a lot of movement to enabling LNG export out of Western Canada. And so a lot of gas production here will be sold on the water. But we have a lot of gas. So even with the power demand and all of the gas going into the LNG market, we think there'll be upward pressure on gas prices, but that will enable the production of more supply.
So it does feel, to get back to the regulatory environment, that there's this contradiction. You saw it in the One Big Beautiful Bill, keeping tax incentives in place for some of these cleaner energy suppliers because you want the resilience and the independence of the grid, but at the same time basically saying you can't use Chinese suppliers. Is that a big issue for this market?
It's created issues with supply chain. Part of, I think, what we're seeing in the cost pressures, and we know this is definitely the case in the battery area, that the inability to access Chinese supply has increased costs. But it's also this inability to access Chinese supply is producing a movement of the supply chain to other regions of the world.
How hopeful are you? That things are going to get better, things are going to get cheaper, the consumer is going to be the one to benefit, and that, all will be well in the world.
I'm an inherent optimist, so I feel pretty good about things, even in the middle of a lot of disarray in the world. And I would say in this area, there is a confusion around the data center demand, and that it's going to just put a lot of pressure on the consumer. And actually, at the utility level, because of the scale benefits, it's something that can ease rate pressure for customers.
All right, we'll end it on that. Thank you so much for visiting us, George Bilicic of Lazard. Coming up, gold and silver are under pressure as higher oil prices fuel higher for longer rate fears. This is Bloomberg Open Interest. It's time for our metals spotlight. Gold and silver are falling as renewed US-Iran strikes push oil prices higher, adding to higher for longer rate fears. Joining us now is Bloomberg's metals reporter, Jack Ryan. Jack, can we blame everything on Iran, or is this partially a result of what might happen with the Federal Reserve as well?
Yes, well, I mean, ultimately it's been a similar story throughout the year, really. It's headlines come through showing some sort of escalation in the Middle East, and then we get a sell-off. And today we very much had that. It dropped briefly below $4,000 an ounce again. And really it's just about these oil prices feeding through into what the Fed is seeing, potentially feeding through into higher rates this year. And that's punishing gold. You can see that through ETFs and through various other ways of holding gold.
Well, one of the very bullish theses around gold specifically had been those ETFs. So maybe some of the flows stopped there. The other one, Jack, though, had been central bank buying. Has that started to ebb? Why is that not helping hold up or at least put more of a floor underneath the price of gold?
It's a good question, and central bank demand has actually been relatively robust. It's really, I think, the only bright spot in the gold market at the moment is that central bank demand. They bought about 250 tons in the first quarter, which was the fastest in a year, actually. But I think it's the power of the ETF outflows. I think that's really the kind of marginal price setter in gold at the moment, and that's why we're seeing this weakness.
So, Jack, a while back, silver and gold bifurcated, right? They went in different directions. Why are they going in the same direction now?
Silver has had a much more dramatic ride than gold. It's been much more volatile generally. There was a lot more speculative and retail interest in it relative to kind of the rest of the investor flows. And so kind of once that came out in January, it hasn't had the same level of support. Some people have pointed to a potential weakening in the industrial demand picture for silver as well. And that's why I think we can see silver acting as it normally does, which is when gold goes one way, silver goes twice as far the same direction. And that's what we've seen over the last couple of months.
Jack, just in terms of what some of the strategists are saying that you've been discussing, given that gold has started to become somewhat of a problem child, have we seen downgrades in expectations, or is there any hope for the precious metal?
Yes, well, I mean, or investment banks, I should say, have been kind of cutting their forecasts throughout the year, really just bringing it in line with where the prices are. The overriding kind of thesis you get, which is what you got through last year, is pointing to these bigger themes of dollar debasement, rising debt, this kind of stuff. So most analysts are still actually bullish. But as I said, they've been cutting their forecast throughout the year. And a lot of people see this kind of this dynamic of rising rate expectations and ETF outflows. A lot of people say don't stand in the way of this while this is happening, because we don't know exactly yet whether $4,000 an ounce is support for gold.
Sure, don't catch a falling knife. You've heard it before. Jack, thank you so much for joining us. Bloomberg's Jack Ryan on gold as prices hover just above $4,000. Let's take a look at what's ahead for the market this week, because it is a really busy week. Tomorrow we're going to get big bank earnings. Those kick off with results from Goldman Sachs, JP Morgan, Wells Fargo, Bank of America, and Citi.
And we're going to get some inflation data, the latest CPI print up first, and then of course we get PPI and the Fed chair, Kevin Warsh, set to testify in the House tomorrow.
And we're going to get a huge amount of Fed speak. Maybe they just do the heavy lifting for Kevin Warsh, who doesn't want to say much. Wednesday, then it'll be Morgan Stanley's turn to report earnings. They go at it alone. And then we're going to get another round of Warsh, but that time in the Senate, followed by PPI data.
And then finally on Thursday, results from Netflix after the closing bell.
And markets, after 2 weeks of gains, struggling to put anything into the green today. We are down 1.25% on the Nasdaq and down 0.4 for the S&P 500. This is Bloomberg Open Interest.